As your investing coach, it's my personal mission to teach you how to become better at managing your money. That's why every week I'm devoting a segment to Cramer's Playbook, where I go back to basics and explain both the personal finance stuff that nobody's going to teach in school and important investing ground rules that we sometimes gloss over because there's just not enough time in the show for me to repeat the stuff every day. But today is your lucky day, because I've been going through your hashtag Get a Plan questions on Twitter at Jim Cramer, and lately I've seen a lot of basic money management queries that I know I can answer for you. So this week, what we're going to do is a two-part playbook, one today and one tomorrow, where Professor Cramer will be teaching you Investing 101. Think of this as investing for beginners. It's stuff you absolutely need to know, but don't worry, for those of you who are already experienced at managing your own money, I'm going to throw in some useful advice for you too. This all started with a tweet from @AlexisCookCSR, who tweeted at Jim Cramer, "Where do I start to get involved in the stock market? Hashtag Get a Plan." What I'm about to say is going to sound glib, but I'm actually being very serious. You should pick up a picture. I wrote this book for you, Alexis. Get Rich Carefully. You should read it. Read it from cover to cover. I'll sign it for you this weekend at Costco in East Hanover, New Jersey, noon to 2. I'm not being self-promoted. I'm not kidding. I wrote the book for people to how to figure out how to get started, because too many people tell me I don't know in this brave new world how to do a thing. But to sum things up, I believe, and it says it in the book, in a diversified portfolio of 5 to 10 individual stocks, that's the best way to go. Now, before you start picking stocks, you need to forget everything you've ever heard about that classic piece of so-called investing wisdom, buy and hold. Look, we don't buy and hold here on Mad Money. It's a great way to lose your or Cramer's shirt. Instead, we practice buy and homework. That means if you're going to pick individual stocks, you got to be willing to read a company's SEC filing, the annual report, the 10K. You got to read the quarterly. The most important element of the homework is going over the earnings reports, and not just the earnings release. You have to actually listen to or read the transcripts of the quarterly conference call. There is no better source of information than these calls. Now it's incredibly easy to listen to them. In my book, I tell you how to. I break it down so you know what to listen for. You also have to research the company's sector. Try to figure out if this is a good moment in the business cycle to own things in the industry you're looking at. You know, if China's weak, no, it's not a good moment for industrials. And then compare the stock to its competitors to see if its valuation makes sense. Or if maybe something else is a more attractive buy. You've got to do that checklist like that. If you're not willing to put in at least that much work, if you're not, you know what? I know it's a stock show, but you should stay away from owning individual stocks. Stay away. The fact is, investing, like everything else in life, takes effort if you want to be good at it. I'm not trying to guilt trip you into spending more time doing your homework. I know of a lot of people who just don't have the time or the inclination to do the individual stock research that I just traced out. Oh, and to have a meaningful, diversified portfolio, get this, you can't start. A lot of people say, hey, Jim, I have $100, I have $1,000, I got $1,500. Hey, Jim, I got to do that. No, I don't even want you to pick a stock until you save $10,000, okay? Save $10,000, because there's not much point in individual stocks until you save that and put it in an index fund. All right, which brings me to this question from Mark_Beal, who tweets, in what index fund should a young investor put his first $1,000? At Jim Cramer, hashtag Get a Plan. Great question. If you don't have $10,000 to invest in individual stocks, or you just don't have the time to manage a portfolio of individual stocks, then you should put your money into an index fund until you get to $10,000. Specifically, you want a cheap index fund with low fees that mirrors the S&P 500. That way, you'll have exposure to American equities. And by the way, historically, they've been a terrific asset class longer term. Remember that you'll never beat the market. You are simply joining it when you pick an index fund, which is why I always say picking your own stocks is the best option. But for those of you who can't commit to stock picking, keeping your money in an index fund that mirrors the S&P 500 is a perfectly fine way to go. I like the Vanguard 500 index. That's the VFINX. Very low fees on that one. Again, first $10,000 index fund, not stocks. Stop tweeting me and saying, I've got $900, I want to buy a stock. I'm not going to let you do that. Or go follow someone else. However, if you do have the time and inclination to own individual stocks, then your first step is to build yourself that diversified portfolio. I've gotten a ton of tweets about what constitutes a diversified portfolio and what you should put it in. So let me spell things out. Diversification is simple, but people are always tempted to forget about it, which is why we play Am I Diversified every week. In a nutshell, you're diversified when no more than 20% of your portfolio is in the same sector. Diversification is all important because if something happens that crushes one particular group of stocks, you don't want it to eviscerate your portfolio. I've seen too many people who put all their eggs in one basket. It's a common phenomenon. And when the basket broke, they lost everything. We saw it in 2000 with tech. Again, in 2008 with minerals, mining, and machinery. And in 2009, at the beginning of the year, with banks. Don't make that mistake. So, if you're building a diversified portfolio, you need a minimum of 5 stocks. Any less, and you'll break the 20% rule I just mentioned. On the other hand, my rule of thumb is that you don't want to own more than 10 stocks because then you got way too much homework to do. You'll be your own personal mutual fund. No one can do that if they have a full-time job. For example, if you were to build a portfolio right now, here's some suggestions of how to lay it out because I get that constantly. First, you want an oil stock, an oil and gas play. It's a way to play the American energy renaissance I'm always talking about, hence why we went to an oil regal money, why I wrote about the theme and get rich quickly. For your oil name right now, because I like to look at what's down, EOG. Okay, it's been hammered. Second, you want a tech play, something that's riding the wave of social, mobile, and cloud. I think you should take a hard look at Google. I show you why Google is worth what it is in the book. Another charitable trust name, maybe Salesforce.com. Hey, that stock's down almost 10% from its amazing quarter. Third, with the global economy now in recovery mode, you got to own an industrial. I'm not going to be squeamish about China. It'll come back eventually, and that's why we like Johnson Controls, JCI. It's gotten crushed here because of China and European weakness, but it's a terrific industrial, and I believe it could unlock a lot of value if it wanted to break itself up. For the fourth slot, a retailer, perhaps Costco. That just got banged up down here. Whole Foods has come down a lot. A powerful natural and organic theme. Stock number 5, healthcare. If you're a conservative investor, go with Merck, a big pharma company has a solid 3.1% yield, major restructuring going on. Maybe more aggressive, you go with Gilead, one of my 4 horsemen of the big pharma apocalypse that I talk about all the time in the show and in the book. Gilead's down a lot from its high. Finally, let me give you an alternate on the top 5 sectors. How about something like an entertainment stock? Big buybacks here, CBS, Viacom, Time Warner, Cramer, Fave, Disney. Here's the bottom line. If you're just getting started as an investor, remember that to own individual stocks, you got to do some homework. You got to stay diversified, keeping your money spread out among many, maybe 5 or 6 sectors. Right now, I recommend domestic oil, tech that's riding social, mobile, and cloud, a high-quality retailer, a healthcare stock, and perhaps an entertainment name. Stay tuned tomorrow for more Investing 101. And for more basic financial advice, please, please, please check out yourmoney.cnbc.com. Stick with Cramer.